This story doesn't start in Europe, but in the United States. Before 2007, the American GDP was regularly growing, and nobody could predict that a major financial crisis would take place soon. But then, the first signs arrived.
It was the worst day on Wall Street since the crash of 1987.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
The crisis was severe and not anticipated. The American GDP dropped by 5%. The American crisis became a world crisis. The world GDP decreased by 1%. It looks like a small kick on this graph, but it is huge because it took place at the world level. This small 1% drop represents more than 1 million of billions dollars. Seeing that, how did the firms and households react? They decided to wait and see. They postponed their not essential purchase and investments. The consequence was a massive trade drop in the world of 10%, much more than the 1% GDP drop. Trade overreacted to the crisis. This trade drop of 10% is the biggest trade drop ever observed. The reason is that all the countries reduced imports and exports at the same time. At the meantime, on the exchange market, exchange rate volatility increased massively, 3 times more than usually. This was not good for the firms, which need to know in advance how much goods they will sell, how much profit they will make, so that they can adapt their production. With so much uncertainty on the exchange rate market, anticipations are much more complicated. Did the exchange rate market become crazy everywhere in the world? No! A small area remained stable during the storm, the Eurozone. But why? Thanks to the euro, the single currency. There is no exchange rate among the Eurozone members, which share the same currency. There is therefore no uncertainty on exports and imports prices in the Eurozone. Firms can export without fear. Do not imagine, however, that trade did not drop in the Eurozone. It did. The question is, what would have happened if there had not been the euro to bring stability to the exchange rate market? To answer this question, we compare the Eurozone countries with other comparable countries, the other most developed countries, in green on the map. Blue line, the Eurozone trade. Green line, the most developed countries trade. You can see that the drop in the Eurozone was smaller, and the rebound after the crisis bigger. When the euro was introduced in 1999, an increase of trade was observed. Indeed, the euro removed transaction cost and exchange rate uncertainty, and therefore promoted trade. The positive effects of the euro on trade is already known. However, during economic crisis, the world became much more uncertain, and the euro has a premium with its stable exchange rate. Euro protects trade among its members, especially during crises. This unexpected advantage of the euro should be highlighted. It should be taken into account by the members of the European Union that did not join the euro yet.